Net worth is a simple concept. It's what you own minus what you owe. It's a snapshot of your financial health. Many people find that their net worth starts to grow much faster once they hit $100,000. This is a significant milestone. Reaching this level often reflects positive changes in financial habits. Before hitting $100,000, people may be focused on paying off debt. They may be learning to budget and save. After reaching this milestone, a shift occurs. Individuals start to see the power of their financial choices. This motivates them to keep going. They become more confident in their ability to build wealth. They are more likely to invest and take calculated risks. This is where the magic of compounding really kicks in. Hitting $100,000 isn't about getting rich quick. It's about building a solid foundation for long-term financial success. It's about changing your mindset and developing habits that will serve you well for years to come. Compounding is the most powerful force in finance. It's a concept that can transform your financial future if you understand and utilize it effectively. Albert Einstein is said to have called it the eighth wonder of the world. He understood that those who grasp the power of compounding can harness it to build significant wealth over time. It's the process of earning interest on your interest. This means that not only does your initial investment grow, but the interest it earns also starts to earn interest. Over time, this can lead to exponential growth. The longer you let your money compound, the more dramatic the growth becomes. Imagine you invest $100 and earn 10% interest. It might not seem like much at first, but the magic happens over time. After the first year, you have $110. This is just the beginning of the compounding journey. The next year, you earn interest on the original $100 plus the $10 you earned in interest. This means your interest is now working for you too. This snowball effect continues year after year. As your investment grows, the amount of interest you earn each year increases. The larger the amount you have invested, the greater the impact of compounding. This is why starting early and contributing regularly to your investments is so crucial. That's why hitting $100,000 is such a significant milestone. At this point, the compounding effect becomes even more powerful. It's at this point that compounding really starts to work its magic. Your money begins to grow at an accelerated rate. Let's say you have $100,000 invested and you're earning a 10% return. This is where the numbers start to get exciting. That means you're making $10,000 a year in interest alone. This is a substantial amount of money that can significantly impact your financial situation. That's more than many people earn in a month or even a year. Imagine having this kind of passive income stream working for you. Compounding is like having your money work for you 24/7. It's a relentless force that doesn't take breaks or vacations. It's the closest thing to passive income there is. Once you set it in motion, it continues to grow with minimal effort on your part. The earlier you start investing, the more time you have to benefit from the power of compounding. Time is your greatest ally in building wealth through compounding. For young investors, this means starting as soon as possible, even with small amounts. The key is consistency and patience. Over decades, even modest investments can grow into substantial sums. This is the true power of compounding at work. This is especially important for retirement savings. The earlier you start, the more comfortable your retirement can be. Compounding can lead to financial freedom, allowing you to live the life you want without financial stress. It can also help you build generational wealth, providing for your family and future generations. Understanding and leveraging the power of compounding is one of the most important financial lessons you can learn. Start today and let your money make money for you. Investing is crucial for growing your net worth beyond $100,000. It's a powerful tool that can help you achieve financial independence and security. It's not enough to save your money, you need to put it to work for you. Simply letting your money sit in a savings account won't yield significant returns due to low interest rates and inflation. When you invest, you're essentially buying a piece of a company, a piece of real estate, or a piece of a financial asset. This means you have the potential to earn returns through dividends, rental income, or capital gains. The goal of investing is to grow your money over time. By making smart investment choices, you can increase your wealth and achieve your financial goals, whether that's buying a home, funding your children's education, or retiring comfortably. There are many different ways to invest, but some of the most common include stocks, bonds, and real estate. Each of these investment types has its own characteristics and can play a unique role in your portfolio. Stocks, for example, represent ownership in a company. When you buy stock, you're buying a small piece of that company and you become a shareholder. Each investment carries its own risks and potential rewards. Stocks can be volatile, meaning their prices can fluctuate widely in a short period. Stocks represent ownership in a company. When the company performs well, the value of your stock can increase, leading to capital gains. When you buy stock, you're buying a small piece of that company. This ownership can also entitle you to dividends, which are a portion of the company's profits paid out to shareholders. Stock prices can go up or down, so there's risk involved. However, the potential for high returns makes stocks an attractive option for many investors. However, stocks have historically provided higher returns than other asset classes over the long term. This makes them a key component of many investment portfolios. Bonds are like loans that you make to a company or government. In return, the issuer of the bond agrees to pay you interest over a specified period and return the principal amount at maturity. They typically pay a fixed rate of interest, making them less risky than stocks. This fixed income can provide stability and predictability to your investment portfolio. However, bonds also tend to offer lower returns compared to stocks. This trade-off between risk and return is a key consideration when building a diversified investment portfolio. Real estate involves buying and selling properties. It can be a great way to build wealth, as property values tend to appreciate over time. It can be a great way to build wealth, but it also requires a significant amount of capital and can be illiquid. This means it can be difficult to quickly sell a property if you need access to cash. The key to successful investing is to find the right mix of investments for your risk tolerance and financial goals. Diversification, or spreading your investments across different asset classes, can help manage risk and improve potential returns. By diversifying your investments, you can reduce the impact of any single investment's poor performance on your overall portfolio. This strategy can help you achieve more stable and consistent returns over time. Remember, investing is a long-term journey. It's important to stay informed, be patient, and make decisions based on your financial goals and risk tolerance. With the right approach, you can put your money to work and build a secure financial future. Diversification is a fancy word for not putting all your eggs in one basket. It's a fundamental principle in the world of investing that can make a significant difference in your financial journey. It means spreading your money across different types of investments. By doing so, you are not overly reliant on the performance of a single asset. The goal of diversification is to reduce your overall risk. When you diversify, you are essentially creating a buffer against the unpredictable nature of the markets. Imagine you invest all your money in a single stock. This might seem like a good idea if you believe strongly in that company's potential. If that stock does well, you could make a lot of money. The returns could be substantial and you might feel like you've hit the jackpot. But if that stock does poorly, you could lose everything. The risk is high because your entire investment is tied to the fate of one company. However, if you spread your money across 10 different stocks, the impact of one stock doing poorly is much less significant. The performance of the other stocks can help cushion the blow. Diversification is important because it helps protect you from losses. It's like having multiple safety nets in place. When one investment is down, another might be up, balancing out your portfolio. This balance can provide more stability and peace of mind. It's like having a financial safety net. Diversification doesn't eliminate risk, but it does spread it out, making it more manageable. You can diversify your investments across different asset classes. This means not just investing in stocks, but also considering bonds, real estate, and other types of assets. You can also diversify within each asset class. For example, within stocks, you can invest in different sectors like technology, healthcare, and consumer goods. For example, you could invest in stocks of companies of different sizes, industries, and geographic locations. This way, you're not just relying on the performance of one market or region. Diversification is not a guarantee against loss. It's important to remember that all investments carry some level of risk. However, it is one of the most effective ways to manage risk and improve your chances of long-term investment success. By diversifying, you are taking a proactive step towards building a more resilient and potentially more profitable investment portfolio. Consulting with a financial advisor can also help you understand the best ways to diversify based on your individual financial goals and risk tolerance. Remember, diversification is a strategy that can benefit investors of all experience levels. Whether you're just starting out or have been investing for years, spreading your investments can help you navigate the ups and downs of the market more effectively. Over time, a well-diversified portfolio can lead to more consistent and reliable growth, helping you achieve your financial objectives and secure your future.